Hi, and good day to everyone. We are now in Chapter 10, with the new topic on fixed income securities. Which basically you are going to learn about bond as another security for investment purposes. The learning goals for this chapter includes, first, understanding the basic investment attributes of bonds, and their use as investments. Second, describe the essential features of a bond and understand the role that the bond ratings play a part in the market. Third, explain how bond prices are quoted in the market, and why some bonds are more volatile, or risky than the others. And last, identify the different types of bonds, and the kinds of investment objectives these securities can fulfill. Let us start with the basic question on what bond is. A bond is a fixed income instrument that represents a debt, or liability security, made by an investor to a borrower. A bond could be thought of as an IOU between the lender and borrower that includes the details of the lending and its payments. Borrowers issue bonds to raise money from investors who's willing to lend them money for a set period of time. When investors buy a bond, they are basically lending to the issuer, which may be a government, municipality, or corporation. In return, the issuer promises to pay the investors a specified rate of interest at set intervals during the life of the bond and to repay the principal, also known as face value, or par value of the bond, when it matures, or comes due, after a set period of time. Bond certificate used to look like this. Among the essential features, or information of the bond that can be spotted on this certificate, such as the face value or par value, the maturity date, and the coupon rate. In the modern system, however, no more physical certificate is issued to the investors. Nearly all securities are now issued in book entry form, meaning they are registered in the investor's name electronically. By issuing bonds, companies, governments or municipalities can have the opportunity to raise large amounts of fund for various purposes, which may include to finance their debts, provide operating cash flow, as well as to fund capital investments or projects. But why companies prefer issuing bonds instead of borrowing from a bank to raise money? Now, borrowing from a bank is perhaps the approach that comes first to the mind for many people who needs money. Hence, the decision of companies to issue bonds, instead of selecting other methods of raising money, can be driven by many factors. The interest rate that companies pay bond investors is usually less than the interest rate available from banks. Companies are in business to generate corporate profits, so minimizing the interest is an important consideration. That is one of the reasons why healthy companies that do not seem to need the money often issue bonds. The ability to borrow large sums at low interest rates gives corporations the ability to invest in growth and other projects. Issuing bonds also gives companies significantly greater freedom to operate as they see fit. Bonds release firms from the restrictions that are often attached to bank loans. For example, banks often make companies agree not to issue more debt, or make corporate acquisitions until their loans are repaid in full. Such restrictions can hamper a company's ability to do business and limit its operational options. Thus, issuing bonds enables companies to raise money with no such strings attached. From an investor perspective, investment in shares of stock grants proportional ownership in the firm to investors. This is another popular way for corporations to raise money. From a corporate perspective, on the other hand, they may feel that issuing bonds is more attractive proposition because it does not affect ownership of the company or how the company operates. Stock issuance, on the other hand, puts additional stock shares in circulation. That means future earnings must be shared among a larger pool of investors in a form of dividends. As a bondholder, investor will receive interest in a form of coupon payments. Bonds are typically considered as a safe fixed income investments compared to stocks, but they do come with certain risks as well. Though risks associated with bond investment are generally low, but they are not completely absent. For instance, bond investors are subjected to credit risk if the issuer defaults on its debt obligations, or interest rate risk, which could either reduce or increase the market value of a bond. Why investors invest in bonds over stocks. In times of heightened risk aversion, investors typically shift their investments from higher-risk financial instruments, like stocks, to a safer fixed-income assets such as bonds. Due to their lower risk and fixed-income characteristic, bonds might not provide the returns compared to the stocks. However, they are an essential part to any investment portfolio. Typically, bonds pay interest semi-annually, or annually, providing a predictable income stream over a set of period. Many people invest in bonds for that expected interest income, or a yield, and also to preserve their capital investment. Bonds also are an important component of a strategically diversified portfolio, at any stage of an investor's life. Having a diversified portfolio, which includes bonds over the long term, can often provide comparable returns with less risk than a portfolio devoted to only one type of investment over a longer period of time. Thus, it is recommended for any investor to balance their portfolios with high, medium, and low-risk investment products, and bonds can provide investment stability to help buffer against the volatility of the stock market. Suffice to say, among the benefits for investor to invest in bonds include consistent income stream, preservation of capital, allows diversification, and literally lower risks than stocks. As mentioned earlier, while bonds considered a safer option than stocks, they do have several common risks attached to it. The most well-known risk in the bond market is interest rate risk. Interest rates have an inverse relationship with bond prices. When an investor buys a bond, he commits to receiving a fixed rate of return or ROR for a set period of time. If the market rate rises from the date of the bond's purchase, its price will fall accordingly. The bond will then trade at a discount to reflect the lower return that an investor will make on the bond. The inverse relationship between market interest rates and bond prices holds true under falling interest rate environments too. The originally issued bond would sell at a premium, or above par value, because the coupon payments associated with this bond would be greater than the coupon payments offered on newly issued bonds. The example given, based on the supply and demand concept, provides us with clear understanding on why the bond prices and market interest rates are inverse relationship. Other forms of risks associated with bonds that investors should also be aware of include liquidity risk, which describes the uncertainty to sell bond for its market value. Liquid bonds, like sovereign bond, are usually easier to sell than illiquid bonds, such as those from risky companies. Next is credit risk, that occasionally occur when a bond issuer runs into serious financial trouble and cannot pay its debts. This is called defaulting. Junk bonds have more credit risk, while government bonds have almost no credit risk. Inflation risk occurs because the rising inflation, which can cause interest rates to rise, and simultaneously driving down bond prices. Low-return bonds, such as government bond, may also run the risk of failing to keep pace with inflation. Like, if a bond pays 2% interest, while inflation is higher at 3% rate. And finally, reinvestment risk can occur if the proceeds from the bond, or future cash flows, will need to be reinvested in a security with a lower yield than the bond originally provided. Reinvestment risk can also come with callable bonds, where bonds that can be called by the issuer before the maturity rate. Before placing an order to buy a bond, an investor must consider the credit rating of the bond. Credit rating refers to the ability of the bond issuer to make all required interest payments and to repay the principal balance on time. Bond ratings are generally letter grades. It designate investment quality, where it corresponds to the level of credit risk. Based upon financial analysis of the bond issuer, investment grade ratings are received by financially strong companies, while junk bond ratings are received by companies making payments, but default risk is high, which also known as fallen angels. So, investors will pay close attention to agency ratings, because ratings are tied to bond yields. Generally, the higher the credit rating, the lower the risk, and vice versa. Higher yields are there to entice investors to take a higher risk, as a bond with a lower rating is deemed to have a higher risk of not paying interest and principal payments. There are bond rating agencies that assign a creditworthiness score to bonds issued. Malaysian Rating Corporation Berhad and Rating Agency Malaysia provide credit rating services in the Malaysian bond market, while, in the United States, the three primary bond rating agencies are Standard & Poor's Global Ratings, Moody's, and Fitch Ratings. Talking about the specific types of bond in Malaysia specifically, there are two types of government bonds that can help government to raise more capital. The first one is called Malaysian Government Securities, or MGS, and the other one is Government Investment Issues, or GII, that following Islamic principles. There are also government-guaranteed bond issued. For example, bonds from Danane Furnesian Al Berhad, Taurus Pesa Watson Dirian Berhad, Johor Corporation, PTPTN, Sirikat Prazarana Negara Berhad, and Khazanah Nesian Al Berhad. Apart from that, there are also bonds issued by government-linked entities, such as Project Labak Raya Usaha Sama Berhad, Petronas Chemicals, Sarawak Energy Berhad, Putrajaya Holdings, and Telecom Malaysia, which provides opportunity for investors to invest. Finally, corporate bonds, or sukuk under Islamic principles, that are issued by various corporate entities also, are among the many types of major market segments of bond issuer. In addition to the bonds described just now, investors can buy several specialty issue bonds that possess unusual issue characteristics. These bonds have coupon or repayment provisions that are out of the ordinary, and they are issued by corporation and governments. Four of the most actively traded specialty issues are asset-backed securities, zero-coupon bonds, mortgage-backed securities, and high-yield junk bonds. Before we end, let us walk through on the development of bond market in Malaysia so far. Generally, bond issuers in Malaysia have an option to issue bonds under the conventional or Islamic principles. In 2012, the Securities Commission launched the Malaysian Retail Bonds and Sukuk Framework to provide retail investors direct access to invest in bonds and sukuk. This launch is in line with the initiative set out under the Securities Commission's Capital Market Master Plan 2 to facilitate greater retail participation in the bond and sukuk market. Previously, retail investors could not access this asset class directly. Banks only sold bonds to the institutional investors, or high net worth individuals, for at least Rm. 250,000. And this high amount of capital needed has limit, which is the involvement of retail investors. Under the new framework, retail bonds and sukuk may be issued by certain eligible issuers, as mentioned earlier, and traded either on the exchange of Bursa Malaysia or over the counter through appointed banks. This allows issuers to have access to a larger pool of investors and facilitate greater participation in the bond and sukuk market. With the seasoning framework, retail investors are able to buy bonds and sukuk for as low as Rm. 1,000 on the platform. You can find more news on this development, especially on the investment of retail investors in bonds market, from the relevant online news and articles. Okay. We have come to the end of this chapter. I'm Billy, an assistant to Dr. Carmilla. Thank you for listening, and hope to meet you again in the next topic.